Yeah, we've been through a pretty volatile period of the last few years after the financial crisis, and markets have been moving pretty sharp and fiercely on the back of economic and political risk. So a large number of the opportunities today are more about a retracement of previous successes. So, the flight to quality we saw, which sort of bid up the valuation of the sort of US market in particular. A lot of the big US expensive staple companies have been sort of overloved, I think. And so, I think at the moment there's a sort of almost like an avoiding strategy about going elsewhere, using the US as a source of cash and looking around the world and assessing what's cheaper today. I think from a market level, Japan, after being in a bear market for a couple of decades, is looking pretty good value. Emerging markets is a great opportunity both on a valuation basis and from a stock picking perspective. Lots of volatility there, which is great for sort of fundamental stock pickers. I think Europe's had a good run, and that's probably played out now. The European banks have been at the sort of the forefront of a rally following the sort of the ECB coming out in support of markets last year. So that's probably played its course. So I think it's about basically avoiding the US and investing elsewhere. I think that would be my tip for the next 12 months. Investors have been used to decades of low volatility, steadily rising markets up until 2007, and then suddenly, like this, tsunami hit of the global financial crisis, and people are getting used to living with volatility now. And I think that's actually probably the name of the game going ahead. What went on before 80s, 90s, 2000s, early 2000s isn't going to be repeated again anytime soon. So I think investors have got to get used to living with volatility. That doesn't scare me in the slightest, but I think that creates opportunities as an investor. Lots of anomalies are being thrown up at the moment, and I think a big scalable global investment process like the one that Schroders operates is really well suited to vacuum up a lot of those opportunities. Being a global investor, unfortunately, you've got to look at everything. You can't just take your eye off the ball at all. There's so many sort of moving parts. But if I had to name one at the moment, I would say I'm most concerned about sort of currency movements. So there's been a lot of volatility recently. Japanese yen's weakened by 15% in a couple of months, and we're in a situation at the moment now where every country in the world wants to have a weak currency at the same time, and that's not normally a good situation. It can lead to a lot of instability going ahead. So that's where we're keeping a really close eye at the moment. There's no point being a good investor if you're giving it all back on the currency. What we're doing at Schroders on the global equity side is taking really quite a sensible fundamental process, but then we're scaling that up using quantitative tools so that we can analyse a huge number of companies globally. Our universe is several thousand companies, and we're not afraid to go down into sort of mid-cap stocks, look in emerging markets to find some good opportunities. It really is a very broad investment universe for us. We're also not afraid to play a different game. We're not trying to play the winner's game, chasing a few sort of glamour stocks. It's normally about what you don't own, which hurts you, and that's where I spend a lot of time thinking about. I think not being afraid to be different from the peer group is also essential in this type of market. And our fund is benchmark unconstrained, very little overlap with conventional sort of market cap weighted indices such as those produced by MSCI. Very high conviction in what we do, even though we're delivering a sort of diversified, well-rounded sort of portfolio. It's actually taken a very different stance.